Okay, I'll now move to the next chapter, which is on interest rate risk management. Let me first set the context of the chapter. Once that is set in, more or less things will become fairly simple. What we are trying to do in this chapter is like you have forex risk management or equity risk management, we have something called as rate risk management. What is first interest rate risk is variation in my cash flow due to changes in interest rate. You will have to just imagine the structure or the importance of the chapter. Variation in my cash flow due to changes in interest rates. For example, I've taken a housing loan. My salary income is fixed. I've taken a housing loan. I was paying an EMI of 40,000 per month. Suddenly RBI increases interest rates. My EMI starts going up. I get impacted. I was a person who has retired. I was getting regular interest income. The FD rates were 6%. RBI reduced the rate. My income started going down. So the objective is, how do I protect myself from this problem? This I'm talking from an individual retail investor point of view. This you can extrapolate to the company. The company will also get impacted when interest rates go up as well as when interest rates go down. Some companies get favorably impacted in one scenario, adversely impacted in the other scenario. If you are having a lot of loans in your balance sheet and RBI increases interest rate, banks will pass on that interest rate increase to you. You will get impacted. Your profits will go down. If you have a lot of assets in your balance sheet and you create this as fixed deposit, RBI reduces interest rate, you are under problem. So increase in interest rate as well as reduce in interest rate, both are trouble for us. I don't want to be impacted by this, which is where the chapter has come into picture. Interest rate risk management is to protect ourselves from increase or decrease in interest rate. Now, what are the tools I have? Exactly the same thing which we did in derivatives. First, I have call option, put option, which is called interest rate option. Here the name is called cap and floor. The call and put of theirs is called cap and floor here. Then there you had interest rate, derivatives had futures. Here we have interest rate futures. In forex, we will do forward contract. Here it is called interest rate forward, and then we have something called is interest rate swaps. So basically exactly the same tools which are there for stock, currency and commodities, the same thing are there for interest rate also. So I have a call option which is technically called a cap option here. Just write this alone. Call option. What you do there, call option. Here it's called cap option. Call option is called cap option here. Floor option. Sorry, put option. Put option. That is called floor option here. Call and put option. Here it's called cap and floor. Futures. Here it's called interest rate futures. Forward contract. Interest rate forwards. Forward contract. Normal forward contract you do in forex. Here the terminology is called interest rate forward. And you will have currency swaps. Here it's called interest rate swaps. So whatever you had in a normal contract or normal chapters, everything comes here, just that the name undergoes a change. Call option, a put option, futures, forward and swap. Exactly the same tools are there in interest rate as well for risk management. What is risk management? Is protecting myself from increase or decrease in interest rate. I don't want interest rate to increase. I don't want interest rate to decrease. Both are not in my hand. I cannot do anything about it because RBI can increase interest rate, RBI can reduce interest rate. Now, what does a cap option do? First, we're discussing cap option and floor option. Like we have option, see in futures, I do not have a choice. For example, I decided, let's take an example that I want to take a loan after 1 year. You want to take a loan after 1 year, you can freeze that rate today. by doing a futures contract or a forward contract. By doing a futures contract or a forward contract. If you take a futures contract, your actual loan will happen at the actual rate and there will be a net settlement like what we did there. What is net settlement? Date, position, action, reference date and rate. You will do a net settlement and you will get your settlement amount. Now in futures, I do not have a choice to say no. In option, if terms are not beneficial for me, I'll not exercise the option. I will not exercise the option. So obviously I'll have to pay premium today. I'll have to pay a premium today for a call option or a put option, cap option or a floor option. Cap restricts my maximum interest. Cap restricts my maximum interest, useful for borrowers. Useful for borrower. For example, I put a cap of 7%. If actual interest rate is 6%, I'll borrow at 6%. I'll go ahead and borrow at 6%. Why should I pay 7%? But if it's more than 7%, I'll borrow at the actual rate, but get a cap settlement. Get a cap settlement. For example, if interest rate, if actual price is more than the current market price, I'll ask you, do you want to buy at 100 when the price in the market is 120? You will say yes. I'll give you 20 rupees settlement and you can buy it in the market at 120. So purchase or loan will happen only at the actual rate, but there will be a settlement which will come. There will be a settlement which will come. That settlement is called as cap settlement or a floor settlement or a collar settlement. Different names are there. Cap option, which is like a call option, restricts the maximum interest outflow, useful for borrowers. Useful for borrowers. In case my actual interest is higher, I'll use the cap option and try to reduce my interest outflow. Floor is useful for minimum selling price. Floor is useful for minimum selling price, which is minimum interest income. Minimum interest income. Who will use this? I have retired. So during retirement, I wanted the use of a floor option so that I get minimum income. So this minimum income will come through floor option. This is useful for lender. I can decide to do them together. Which is called collar option. What is a collar option is? You will buy a cap as well as sell a floor. Why do I do collar option? Because I want to reduce my premium expense. If you buy a floor, what you will get? If you buy a floor, what will you get? Minimum interest income. So if I sell a floor, I will have minimum interest outflow. What does a cap do? Maximum interest outflow. So what does a collar do? Maximum minimum. That is, if interest rates go down, you will not get benefited. If interest rates go up, you will not get impacted. You will be in a range. That range is called collar option. There will be a strike rate for a call option. There will be a strike rate for a put option. Like that, there will be a strike rate for cap option. There will be a strike rate for floor option. Some question may use the word interest rate guarantee. Interest rate guarantee can be an interest rate cap, can be an interest rate floor, depending on whether you are a borrower or a lender. Instead of giving the type of the option directly, I use the word interest rate guarantee, which means it can be a call option or a put option, or it can be a cap option or a floor option, depending on what. If you are a borrower, interest rate guarantees interest rate cap. If you are a lender, interest rate guarantees interest rate floor. Now, in a normal option versus interest rate option, what happens? In a normal option, my strike price is a normal price. Here, my strike price is an interest rate, 7%, 5%, 6%, 4%. So, I'll ask you a loan. Do you want to take a loan at 6% when the actual interest rate is so much? That is how this will work. That is how it will work. Here, the strike rate is a percentage. Call or cap. If price in market is more than exercise price, we will exercise it. Otherwise, it will lapse. Same thing. If actual interest rate is more than the strike rate, we will exercise it. Otherwise, it will lapse and we will pay lower interest. You will buy at lower market price. Here, you will take a lower interest rate loan. Floor, if price in market is less than exercise price, we will exercise it. Otherwise, I will leave it and sell it at higher price. I'll sell it at higher price. Same thing, if interest rates is lower, I'll use the option get minimum income. Otherwise, I'll sell it at higher income. Otherwise, I'll sell it at higher income. Let's just look at this. You have purchased a 1-year cap on a notional amount of 100 crores. There's a notional amount that is on 100 crores. I have purchased the option. Strike rate is what? If actual interest is more than 8%, you have to pay the actual interest, but you will get a settlement. You will get a settlement. What is the interest in the first quarter? I'll get 0.5% of 100 crore into 3 by 12. 0.5% of 100 crore into 3 by 12 into 3 by 12. Second quarter, 7.5%. Is it more than 8%? No, no settlement for you. You will not get anything from the option. You will not get anything from the option. Will get exercised in the first quarter. Actual interest is higher than the cap rate. We'll get a settlement of 100 crore into 0.5% into 3 by 12. Option will not be exercised in the second quarter. No payoff in the second quarter. Same thing. I purchased a floor option. What does a floor option give? Minimum income. Minimum income. What is the strike rate? I need minimum 8% income. If you are giving me more than 8%, I will not ask anything. If you are giving me more than 8%, I have no problem. But lesser than 8% means you need to give me a compensation. First quarter, what is the rate? No compensation for you. No compensation for you. Second quarter? So what will happen in the second quarter is you will receive 7.5% the actual interest and get a compensation also. Get a compensation also because our options are always net settled. Options are always. Now, how much compensation? 100 crore into 0.5% into 3 by 12. Any doubts on this? Clear? Now, these are the following terms associated with interest rate option. One is a notional amount. What is a notional amount? The amount which we plan to borrow or we are borrowing. I'm not bothered whether you are borrowing it or not. Notional amount is the amount which we plan to borrow. There's something called as a reset period. This is a very tricky adjustment or very tricky point. What is reset period is every loan when you take, the lender will say we will reset the interest based on certain periodicity. Based on certain periodicity. So reset period refers to the frequency at which loan interest can be adjusted. Now the problem with the reset rate is the reset rate practically is applicable retrospectively. Retrospectively means it's applicable for future period. It's applicable for future period. ICI did that in one question. But many questions they applied for the past 6 months. They applied for the past 6 months. That is the previous 6 months they will apply the reset period interest and not the next 6 months. Not the next 6 months. Practically it depends on the assumption or the terms of the agreement. It depends on the assumption or the terms of the agreement. Logically speaking, it should be a retrospective application. It should be a retrospective application. So what we do, there is a reset date. There is a reset date. On the reset date, a benchmark will change. What can be a benchmark? LIBOR, London Interbank Offered Rate, MIBOR, Mumbai Interbank Offered Rate, base rate, RBI's repo rate, reverse repo rate. Some benchmark will be there. I'll have to calculate number of days between the last payment date to this payment date. Our borrowing rate will be there. What is our borrowing rate? You took a loan at some percentage. On top of that, 1, 2, 3, 4 percentage will get added. That is called as a spread, and we will pay interest on this. There will be a premium payment which can come. How is the premium calculated? What happens? I'll explain later. Then there can be a cap receipt or a floor payment. What is cap receipt is? In case you are paying more than that limit, you will get compensation from the other party. What is floor payment? If you are paying lesser than that limit, you have to give compensation. You have to give compensation and then we'll get the total interest. We'll get the total interest. Ideally speaking, I should go ahead and make it simple and do months calculation. But ICI does days calculation. They do days calculation. So you have to calculate the exact number of days between the first payment and the second payment and then do the calculation. So there is a reset date. There's a LIBOR, number of days. Our borrowing rate is calculated. Based on that, interest is paid. Premium will be paid. There will be a cap receipt. There will be a floor payment and total interest. Based on the total interest, you will do the final calculation. Let's understand. XYZ Limited issues GBP 10 million floating rate loan. Issues means you have issued an instrument. Okay, you have issued a bond. You have issued a bond with a resetting of coupon every 6 months equal to what? LIBOR plus 0.5. So you will be paying LIBOR plus 0.5. XYZ is interested in a collar strategy, by selling a floor and buying a cap. That is, you will pay minimum sum rate and maximum sum rate. What is the minimum rate? It should be floor here, okay? For floor, it is 4%. For cap, it is 7%. Now, what is the implication of this? If the actual LIBOR is more than 7, you will get some compensation. And if the actual LIBOR is less than 4, you have to give compensation. If the actual LIBOR is less than 4, you have to give compensation. And if it's more than 7, you will get compensation. Now, what is the effective interest if LIBOR is what? 6 months interest we have to calculate. First, you have to pay 3 plus 0.5, 3.5%. You'll have to pay 3.5%. So you'll be paying 3.5% into 6 by 12, 1,75,000. Did we, our strike rate was 7%. Was the actual LIBOR more than 7? No, no cap receipt for you. No cap receipt. Was the actual LIBOR less than 4? Yes, how much less? Actual LIBOR, no, your rate, actual LIBOR, only they do it on LIBOR. Was the actual LIBOR less than 4%? Yes, how much less? You have to pay that 1% compensation. You have to give that 1% compensation to someone else. He's waiting for you to give that because he's getting a lesser income. He's getting a lesser income. I will pay anywhere between 4 and 7. I don't want to pay less than 4. I don't want to pay more than 7%. Any doubts on this? Okay. XYZ is going to borrow 15 million at 6-month LIBOR plus 10% for a period of 24 months. The company anticipates a rise in LIBOR and is taking a cap option. At a strike rate of what? 8%. Lump sum premium is 1%. So we are now getting into the premium calculation. There's a premium which is given. What needs to be done for that? I'll explain. For the entire reset period, fixed rate of interest. What is the use of fixed rate of interest? Also, you'll understand. They've given how many reset period? 3. This is 6-month LIBOR, means every 6 months you'll be paying interest. 6-month LIBOR means every 6 month interest will be paid. 6-month LIBOR does not mean the annual rate is 6 months. That the given rate is 6 months. The given rate is not 6 months, but interest will be paid every 6 months. What is the loan period we are taking? So ideally they should have given 4 reset period. They should have given 4 reset period. They have not given 1 reset period. I am not analyzing the 4th reset period. They have not given the 1 reset period. I will not analyze the 4th reset period. I will not analyze the 4th reset period. Now write lump sum premium is equal to 1 crore 50 lakhs into 1%. They have told lump sum premium is 1 crore 50 lakh into 1%. 15 million is the loan amount. Premium is 1%. 1,50,000. Ignore the currency and all for the time being. You can, in exam, you can write the currency and all. 1,50,000. Now, I have 2 choices of making the premium payment. I can make 1,50,000 immediately, or I can pay every reset period. Whether you pay immediately or every reset period, for doing amortization or calculation, I'll have to consider premium every reset period. In the format I had given premium. Last 2 questions I did not consider premium because premium was 0. Premium was 0 because we were following a collar strategy. Premium per half year is equal to, per half year, technically reset period, per half year is equal to 1,50,000 divided by present value annuity factor. Divide by present value annuity factor. How many reset periods are there in the loan? So you'll have to divide this in 4 years or 4 reset period. 4. What is the fixed rate of interest given? 7%. What is the word? Per annum? I'm doing per half year calculation. I'm doing per half year 3.5%. So tell me the annuity factor for 4 and 3.5%. 3.67 and get the answer. 1,50,000 divided. Give me a 4 decimal. I think somewhere question talks about 4 decimal. 3.6731 and get the premium. 40,000. So every reset period, I have to pay a premium of 40837. Every reset period, we need to pay a premium of 40,837. Assume you say I pay immediately, no problem. Time value of money, amortization is 4837 per reset period. You cannot divide by 4. If you divide by 4, you're ignoring the time value of money. Now, questions requirement, let's understand. Question is saying how far interest rate risk is hedged through cap option. What is interest rate risk? Is extra outflow which comes to me due to increase in interest rate. Extra outflow which comes to me due to what? Increase in interest rate. But what will happen if interest rate increase? I will get that as a cap receipt. I'll get that as a cap receipt. But for getting that cap receipt, every quarter you have to pay premium. For getting that cap receipt, every quarter you have to pay, every reset period you have to pay premium. Is there a fourth reset period? Yes, ideally they have not given. They have not given. Now write reset period, LIBOR, interest paid to bank, cap receipt, premium paid, net outflow. Interest paid to bank, cap receipt, premium paid, net outflow. This has no problem of days calculation and all. We'll do 6 months and then close it. 3 reset period. 3 reset period. Is there a fourth reset period? Data is not there. Data is not there. How much is the LIBOR? 9, 9.5, 10. What is our bank loan interest rate? LIBOR plus 10%. So pay interest at the rate of 19%, 6 months. 1 crore 50 lakhs into 19% into 6 by 12. 19% you have to pay. Then you have to pay 19.5%. And last you have to pay 20%. You will have to pay, it's a huge rate, but I can't help it. The question is talking about such rates. LIBOR plus 10%. Problem is talking about LIBOR plus 10%, so I'm paying the higher rate. Clear? Now, what was the strike rate of LIBOR? Did LIBOR exceed 8? Every time it has exceeded, every time you will get a compensation. Every time it has exceeded, every time you will get a compensation. First time you will get 1% 1% compensation. Second time, how much compensation? 1.5. Third time, whether you get compensation or not, you have to keep paying premium 4837. You have to keep paying 4837. You have to keep paying 40,837 whether you are getting a compensation, not getting a compensation, whether you are exercising the option, not exercising the option, premium will have to continue to be paid and I get my net outflow. So it is basically fixed at that 13 lakh 90. It will not exceed that because of the cap option. Because of the cap option. Now be in listen mode. No need to keep writing it. Be in listen mode. Now listen. What is the benefit of the cap option is interest rate risk is extra 337,500. That cap receipt no is the extra outflow of yours which came back. Is the extra outflow of yours which came back to you. If cap was not there, no, you would have paid 43,87,500. Because of the cap option, we have paid how much? 41,72,511. So cap option helped me in saving this by paying this. Help me in saving 337,500 by paying how much? 122,511. That's the benefit of the cap option. How far the risk has been hedged? The company would have paid extra 337,500 due to increase in interest rate. However, due to cap receipt, interest payout for a reset period does not exceed 18%. Hence, in order to save 337,500, we have paid extra premium of 122,517. Hence, the company is able to reduce the interest rate risk amount by 2,14,893 by using cap option. By using cap option. Go through 6. 1,22,000.
But like 48 and Japan.
Where is the fourth reset? I have not analyzed the fourth reset.
But initial that first we are at the point, I think we are at the first phase.
Then I'll pay only 3 reset period premium. Why will I pay 4 reset period?
Anyway, we have to pay
4 reset period has to be there for me to pay 4 premium. So I don't know if it's 3 reset period, then I'll have to divide by 3 period annuity factor. So we divided by 4-year annuity factor. You should divide by 3-year annuity factor then. We don't know the data, so let's not get into what it is. Go through this. I'll explain interest rate futures then.
Sir, I have one doubt.
You tell me.
Sir, only the fixed rate of interest is 7% per annum, right?
Hmm.
How can we understand that, sir? This is what use. Why they have given that fixed rate of interest is 7%?
To amortize the premium. For amortization of premium, that fixed rate of interest is needed.
Okay, sir.
Yeah. Okay. First question on interest rate futures. I don't want you to do anything. Be in listen mode, understand calculation fully. Then next there will be one more question on interest rate futures. There you will do it. Okay. Listen. In 2 months time, ABC Limited will receive 3.9 million, which it wants to deposit in money market for 3 months. It wants to deposit in money market for 3 months. I'm going to get the money after how many time? 2 months. I want to deposit for month 3, month 4 and month 5. ABC Limited at present can deposit at, but treasurer fears a decrease in interest rate and hence wants to hedge it through interest rate future. Today, if you want to create a deposit, you can create at 8%. But I don't have the money today. I don't have the money today. So what I do, I go through futures route. Futures is quoted at what? 93 means rate of interest is 7%. 100 minus 93 is 7. 100 minus 93 is 7. That is how interest rate futures are quoted in the market. 100 minus 93, 7%. The standard contract size in the futures is how much? 0.5 million. 0.5 million. How much we want to deposit? 3.9. 3.9 divided by 0.5 is how much? I'm rounding out off to 8, which means I have not done a proper hedge. Which means I have not done a proper hedge. Proper hedge means I should have exactly covered 3.9 million. Proper hedge. This is the first problem with interest rate future. Practically people avoid futures because of these issues. When we did in that chapter also, sometimes decimals will come, we'll round off and then go ahead with the calculation. What strategy? I'll explain the strategy later. Let's discuss that later. If after 2 months futures is at what? 90.75 means what rate of interest? 9.25. And interest rate in the market is what? Spot and future interest rate is not matching. Spot and future interest rate is not matching. If it does not match, I have a basis risk. I have a basis risk which I talked about when I was doing derivative. I was talking about this when I did derivative. So if these two are not matching, again it will lead to challenge for me. Again it will lead to challenge for me. Let's understand what happens in part 2 of the question. Okay. How much deposit I wanted to create? 3.9 million. Listen, interest income is equal to 39 lakh into what is the actual rate of interest? No, not now. In the part 2 of the question. You will get money only at 10.5%. You will get money only at 10.5%. 39 lakh into 10.5%. That is your deposit or sale of the wheat will happen only at the actual spot price. Will happen at the spot price. So you create a deposit at 10.5%. How many months you want to create? 3 months. Tell me how much is the income you generate? I generate an income of 102,375. My plan was not this. My plan was to generate 7%. How 7%? Because interest rate futures were quoted at 93. You cannot get 8. You cannot get 8. 8 is immediate deposit. You wanted 7%. You wanted 7%. So my plan is to get 7%, which means my hedge is successful if I get 68,250. My hedge is successful if I get 68,250. We will not get 68,250. Two challenges. One 7.8 contract. Second is on the last day 2 interest rate did not match. So next is net settlement. Next there is a net settlement. I don't want you to write anything. Be in listen mode, understand calculations properly. Then next question onwards, you will start doing along with me. What is net settlement is date, position, action, reference date, rate. Day 0, original position. Are we planning to borrow money or invest money? Invest. When do you want to invest? Month 2. At the end of month 2. At what rate you wanted to do? 7%. You wanted to do it at 7%. How is 700 minus 93? This is my original plan. This is my original plan. Then comes month 2. Opposite position. Opposite of invest is what? Borrow. In month 2, what is the month 2 futures rate? Look at the futures rate, not the spot rate. 9.25. 9.25. Listen, 7% is my inflow, 9.25% is my outflow. Why 9.25 is outflow? Because we are borrowing. Why 7 is inflow? Because we are investing. We are investing. So this is inflow, this is my outflow. This is my outflow. Again, I am repeating date, position, action, reference date and rate format. What you wanted to originally do, you told invest. I have written invest. At what rate? 100 minus 93, 7%. You came back after 2 months, found out the actual rate. It is at 9.25. Loss in percentage. I'm losing 2.25%. I'm losing 2.25%. Loss in rupees. 0.5 million, which is 5 lakh, into 8 contracts. 5 million into 8 contract into 2.25% into 3 by 12 into 3 by 12. So how much loss I suffered? 22,500. I suffered a loss of 22,500. Listen for some time. I'll put this loss here and my final income is 79,875, which is not good. I wanted 68,250. I wanted 68,250. What I wanted is only 68,250. I'm getting more. Why am I getting more? Because of the basis risk. What is the actual spot rate after 3 months? After 2 months? Guys, participate. What is the actual spot rate? So ideally, first this should be 10.5. This should be 10.5. This should be, that is the spot rate and the futures rate should match. Second, I should be able to take exactly 7.8 contract. I should be able to take exactly 7.8. If that had happened, I would have got 68,250. I would have got 68,250, which is what my plan was. My plan was to earn what? 68,250. I don't want to earn more. I don't want to earn less. 68,250 will come if you are able to hit 7.8, which you are not able to do. So first problem. Second problem, on the last day, 9.25 and 10.5 is not matching. 9.25 and 10.5 is not matching. I'll repeat again. Our actual interest income will be at the actual interest rate. Will be at the actual interest rate. On top of that, there will be a future settlement, which can be positive, which can be negative. How will the settlement be calculated? Date, position, action, reference date and rate. So you start with the original date, original position. Originally you want to invest, write invest. Originally you want to borrow, write borrow. Invest, borrow, 7 minus 9.25 minus 2.25 and you will suffer a loss. If you have understood this, try the third part of the question. Same thing, interest income and net settlement. Do the third part of the question, same calculation, interest income, net settlement. Interest income and net settlement. Percentages will change. You do 3, I'll explain later. You do 3 as of now. Try that rework part Understand very clearly that actual interest will be based on actual interest rate only, and there will be a net settlement. Please attempt it. I want you to do this. I can quickly rush through the solution, but it doesn't help. And this is one area where I go relatively slow.
Sir,
Yeah,
I actually missed out a part. How is that 9.25 has been arrived? The borrowing interest rate.
100 minus 90.75.
Okay.
Please do the rework part. We are receiving actual interest of 6.5% and getting a compensation of 12,500. Getting a compensation of 12,500. Again, this is not good. I wanted exactly 68,250. More or less is a problem of that basis risk. There's something called as a basis risk. That is on the last day, 6.5 and 5.75 did not match. And second is decimals in number of contract. Decimal is not the bigger issue. The bigger issue is you are not having both the rates same, and practically this much deviation will not be there in the rates. This much deviation will not be there. Question as given. Let us follow that and proceed ahead. I'll discuss a little bit more on this as we proceed. First, let's just set the context side. This is how you will do the calculation. Is this different in a normal future? Normal future also exactly the same. If you remember, you will first say sold at the actual price, then there will be a net settlement, date, position, action, reference date and rate, and you'll get the net settlement. There also I explained if on the last day both are matching, I will not have problem. Otherwise, I will not get the realization which I am planning. I wanted to earn 7%. I wanted to earn 7. If I earn more or if I earn less, that's not good. I don't want to earn more. I also don't want to earn less. 7% is what I plan, because earning more means there's a possibility of earning less also. There's a possibility of earning less as well. Any doubts on this? Can we proceed? Done? Just give me a minute. Now I'll come back to certain important other terms in interest rate future because I've not touched on that. That's where you had asked a doubt. I'll clarify that. Option premium is equal to lump sum premium is notional amount into the lump sum premium percentage. Premium amortization is equal to lump sum premium divided by PVAF, fixed rate of interest, comma number of reset periods. Now coming to interest rate future. Interest rate future can be used to fix the future interest rate like normal. 3 challenges are there. Third challenge I did not discuss, but that can be sorted out easily. First challenge is number of contract in decimal. Second challenge is basis risk, difference between spot interest rate and future interest rate on the expiry date. Third is something called as mismatch of loan duration and future settlement factor. Mismatch of loan duration and future settlement factor. What is future settlement factor in this? Listen. When we did this question, I told you to finally do into 3 by 12 in the settlement. Finally told to do into 3 by 12. That 3 by 12 is because of the word used in the question, which is 3-month futures. 3-month futures. Listen, 3-month futures does not mean it will expire in 3 months. 3-month future does not mean it will expire in 3 months. Today, I can have March 3-month future, April 3-month future, May 3-month future, June 3-month future, July 3-month future, August 3-month future. What is 3-month future is when you calculate your settlement, you will do into 3 by 12. You will do into 3 by 12. If you have 6-month future, you will do into 6 by 12. And if you have 9-month future, you will do 9 by 12. And if you have 12-month future, you will do 12 by 12. We wanted to create a deposit for what period? 3 months. And this is also 3 months. There is no mismatch. There is no mismatch. But if mismatch happens, what needs to be done? We'll have to see. There will be a mismatch. You wanted to create a deposit for 6 months. You're searching for 6-month future. You don't find in the market. You don't find a 6-month future in the market. You wanted a 6-month future, but the market is not giving a 6-month future. Market is not giving a 6-month future. There's a mismatch. How do you sort out this mismatch? Is very simple. Assume you wanted to borrow 100 crore for 6 months. You wanted to borrow 100 crore for 6 months. Future is saying only I have 3 months. 100 crore for 6 months is mathematically equal to 200 crore for 3 months. Is mathematically equal to 200 crore for 3 months. So create futures not for 100 crore. Create it for 200 crore. Create futures for 200 crore. 100 crore for 6 months is mathematically equal to what? 200 crore for 3 months. So this risk, mismatch part can be eliminated easily. Mismatch part can be eliminated easily. For example, last problem we had to do 3.9 million. If that's at 3.9 million for 4 months is equal to question mark for 3 months. Can you tell me what will this question mark be? 3.9 for 4 months is question mark for 3 months. Number of contractors 5.2 million divided by half a million. Number of contractors 5.2 million divided by half a million. I'm repeating again. If I have problem with the mismatch on loan duration, again I'm repeating, 3-month future does not mean it expires in 3 months. In normal future, 3-month future means it expires in 3 months. It expires in 3 months. In interest rate, it is not like that. 3-month future means your profit or loss, that net settlement you calculate, no, that percentage into the notional amount into something you have to do. That is 3 by 12. If it is 6 months, it is 6 by 12. If it's 9 months, it is 9 by 12. So I wanted a 6 month. I wanted a 6 month. Unfortunately, I don't find that. I don't find that. So I do an adjustment. Now tell me this answer to this. Very simple example. Interest rate is 500 minus 95. 100 minus 95. Tell me this. Buy sell part I'll explain later. Let's not worry much about it for the time being. Just get me the number of contract. $30 lakhs for how many months you want to borrow? 30 lakh into 5 months is equal to question mark into 3 months. Why question mark into 3 months? Because these are 3-month future. These are 3-month future. 30 lakh into 5 months for a period of 5 months after 2 months. After 2 months is of no use. Okay. So I have to take how many contract now? 10 contract. We will sell 10 contract for hedging. I'll explain the sell part in some time. Let's not worry for the time being. Steps in interest rate future. Amount to be hedged is equal to loan amount into the borrowing period by the future settlement period. No need to remember the formula. Logic I have told you. Accordingly you get it. Number of contract, amount to be hedged by size of one contract. Actual interest earned or paid, net settlement, effective interest earned or paid, and effective interest rate. What is net settlement? Date, position, action, reference date and rate. For that, one important thought is future settlement period. Future settlement period. Future settlement period is the most important factor to compute profit or loss of future. It is pertains to the duration considered for settlement, distinct from contracts expiration period. It is not contracts expiry period. It is the time period considered to calculate the settlement. Presently in February, a 3-month future contract for December, a 3-month future contract for December will have an expiration 11 months from now. However, in the computation of settlement, the relevant time frame would be 3 months. That is into 3 by 12 you will do. Into 3 by 12 you will do. Understood the difference? There's something called as a future settlement period and there's something called as a expiry period of the contract. What is expiry period is when the contract will expire. What is the future settlement period? You do this calculation, you need to do into something. That into something is the future settlement period. We'll understand as we proceed. Okay. An extension of interest rate future is a cheapest to deliver bond. What is cheapest to deliver bond? This came in the recent exam. What is cheapest to deliver bond is, I said I don't want to do a gross settlement. I want net settlement to happen. Net settlement is how? Date, position, action, reference date and rate. The other guy is adamant, saying that you give me physical delivery. I am telling him I don't have the bond. He is saying I don't agree to all this. You have to give me physical delivery. In practical world, exchange just puts a notional bond. That bond does not even exist. But trading will happen for a notional bond. But that bond does not even exist in the market. But trading is happening. For that. So I explained to the other guy, he is not ready to listen. So exchange says we will give you list of deliverable bonds. You can deliver bond 1, bond 2, bond 3, bond 4, bond 5, bond 6. Some list the exchange will give. In that you will have a cheapest to deliver bond. You will have something called as a cheapest to deliver bond. What is cheapest to deliver bond? Is a bond which will give you profit. So listen, typically futures transaction involve net settlement. However, in cases where physical settlement is preferred, specific bonds mentioned in the contract must be delivered. In practical scenario, exact bonds specified may not be available in the market. In such instance, the contract writer, who is the writer? He sold the option, so he has to now give this. May purchase an alternative bond and give it to the holder. Holder is saying, you are giving me something else. Why should I accept? So the exchange will give something called as a conversion factor. They'll say that other bond, one bond is equal to 0.95 bond of this or equivalent to 1.25 bond of this. They'll give something called as a conversion factor. To determine the value of the newly delivered bond, the holder uses a conversion factor. So I gave you the bond, no? Now you cannot do net settlement. You have to give me money. What money you will give? Future settlement price multiplied by a conversion factor. Which can be more than 1, less than 1. It can be more than 1. I did not give you your bond. I gave you something else. I will decide what to give. I will try to find a bond which gives me maximum profit. How is profit calculated? Inflow minus outflow. What is inflow? Future settlement price into the conversion factor. What is outflow? I have to go to the market and buy it. Which is quoted price of the bond. I'll explain again. For example, I sold 7% interest rate future. If you sold 7% interest rate future, you should find a 7% bond and give it to the other person. Unfortunately, market does not have that bond. So I found 7.5%. I found 6.8% GOI 2029. 2029, whose quoted price is what? So I'll go to the market and buy this at 877.5 and hand it over to you. you will not pay me 1,000 rupees. You will not pay me 1,000 rupees. Why are you not paying 1,000? Because you are saying I wanted a 7% bond. You are giving me what? 6.8% bond. So I will give you 1,000 into 0.9195. I'll give you 1,000 into 0.9195. Understand the chronology of the transaction. What is very simple is I wanted a specific bond. You are saying you do not have the specific bond. You do not have the specific bond. When you do not have the specific bond, you want to give a proxy. You want to give a proxy bond. I have no problem with that proxy bond because the exchange tells list of deliverable bond. My final profit is 1,000 into 0.9195 is my inflow. Who will give this? You have to give me. What will I give you? A bond worth 877.5. A bond worth 877.5. I make a profit of 42 rupees. I make a profit of 42 rupees. Any doubts on this? I'm done with interest rate future. I will summarize till this part of it. I'll summarize till this part of it before I go to forward rate agreement. Before I go to forward rate agreement. So what we learnt is there are something called as a risk called interest rate risk. What is an interest rate risk? Variation in interest rate which is impacting me. If interest rate go up, I get a protection using cap option. Whatever I've explained till now only I'll do. If interest rate is going down, I get a protection using floor option. If you want protection against up or down and don't want to enjoy the fall or increase, see in a cap option, if it goes up, you get protection. If it goes down, you enjoy that benefit. In a floor option, if it goes up, you enjoy the benefit. If it goes down, you get protection. Futures is saying that you will pay fixed 8%. It goes up or goes down. You cannot enjoy the benefit of going down. You cannot have. So a cap option gives me benefit against increase in rate, but allows me to enjoy the fall in rate. Whereas a future gives you protection against increase in rate. No protection, sorry, no enjoyment of fall in rate. No enjoyment of fall in rate. Interest rate future means you will get 8%. But interest rate future had its own set of challenges. So in cap option, my settlement is very simple. Check whether you have exceeded it, notional amount into the exceeded rate into whatever is the time period. Same with floor option. Collar is combination of cap and floor. Combination of cap and floor. Interest rate guarantees a cap option or a floor option depending on whether you are a borrower or lender. Settlement happens in net amount. What are the terms associated? Notional amount is the amount for which the settlement is to be calculated. Reset period is the date on which the interest will be reset. It can be for the prior date. It can be for the future date. One problem we did prior date. One problem we did future date. Now on an option there will be a premium. How is the premium calculated? Notional amount into the lump sum premium percentage. This premium needs to be amortized. This premium needs to be amortized. How do you amortize the premium? Lump sum premium divided by PVAF, fixed rate of interest into the number of reset period. Then came the interest rate future, which has three challenges. One, the amount may not match. That is number of decimal. Second, future settlement period and the interest period is not matching. Mismatch in loan duration and the future settlement period. And the third problem is the basis risk. First problem you can settle by doing an adjustment. What is the adjustment? 50 lakh into 10 months is equal to question mark into 5 months. So that adjustment you can do. Decimal, you cannot do anything. And if the basis risk is there, you cannot do anything. How will the final settlement happen? The final settlement is you will borrow at the actual rate. You will borrow at the actual rate. You will end up borrowing at the actual rate and there will be a net settlement. What is net settlement? Date, position, action, reference date and amount. Now one important part is in case of futures, if you are borrowing money, you will be selling the contract. In borrowing money, you will be selling the contract. In FRA, if you are borrowing money, you will be buying the FRA. In borrowing money, maybe you can remember in FRA, borrowing is equal to buy. B and B can match. If at all you remember there also, if you get confusion, we cannot do anything. In FRA, I keep getting confused. I'm being very honest to you. Borrowing is equal to buy in FRA. Borrowing is equal to sell in interest rate futures. Then one allied concept is your cheapest to deliver bond. What is cheapest to deliver bond is the other party is adamant. He is saying you give me the bond. You give me the bond. So exchange tells I give you 10 options. You choose. So I pick one, buy it and give it to the other person. What will he pay me? Future settlement rate into the conversion factor that he will give it to me. At what is my outflow? I buy it in the market. The gap is my profit or loss. Any doubts on this? Clear? Okay, before I go to FRA, again I'm taking a 5-minute break. I take a 5-minute break and then I do FRA and then we take a full break. I'll take a lengthy break after that. Just 5 minutes break. I'll move to forward rate agreement. Listen, forward rate agreement is very simple. What you do in FRA is you freeze the future interest rate. There is no risk like those three risks which existed there. There we had three risks. What are the three risks? We had the first risk called as number of contract in decimal. There's no number of contract here. Mismatch in duration, nothing like that. Then difference in interest rate, all that will not come here. Reason for that is very simple. This is a over the counter product. If you want exactly 1 crore 25 lakh 20,000 rupees, you can get it for that. You want it exactly for 9 months, you can get it for 9 months. And there is no two market. There's only one interest rate here. You do not have two separate interest rate. Like there we had two separate interest rate. So FRA is a better product as compared to the interest rate futures, and from a problem solving point of view also it becomes very simple for us to do. Let's see. FRA is used to freeze future interest rate for a borrowing or investment. Example, company A wants to borrow after 6 months. Company A wants to borrow. These terms be very clear, okay? After 6 months, borrowing period is start of month 7 till, that is you want to borrow from start of month 7 till month 9. This is technically called as FRA 6 by 9. This is technically called FRA 6 by 9. FRA 3 by 6 means you want to borrow from end of month 3 till end of month 6. FRA 2 by 5 means end of month 2 to end of month 5. FRA 2 by 15 is equal to end of month 2 to end of month 15. FRA 1 by 2 can mean end of year 1 to end of year 2. It can be year also. It can be year also. End of year 1 to end of year 2. FRA 1 by 2, FRA 2 by 3, FRA 3 by 5. It can be yearly, it can be monthly. Now, only thing is FRA is also net settled. FRA is also net settled. Unfortunately, that is what happens here. Our futures, our forward contract is not net settled. Forward contract has physical delivery. Why FRA is net settled is, I wanted to borrow from State Bank of India. Okay, I asked them to give me an FRA agreement. They are not ready to give. So I take an FRA agreement from ICICI Bank, but borrow loan from ICICI Bank. Take a FRA from ICICI, borrow loan from SBI. It can be any combination. So interest rate FRA is also net settled. How is the calculation done? I'll explain in the problem. Very simple calculation. Nothing much tricky there. Let's directly get into a question. Let's come to question 10. P Limited is contemplating to borrow an amount of 50 crore for a period of 3 months in the coming 6 months time from now. Current rate of interest is 8%, but it may go up in 6 months time. The company wants to hedge itself against the likely interest in interest rate. Banker quoted an FRA of 8.3%. Compute the effect of FRA and the actual interest rate if the actual interest turns out to be 8.6 or 7.8. Let's do both the calculation, 8.6 and 7.8. Particulars. You go through the question for a minute. I'll wait. You go through the question. Please go through the question. This is very simple calculation, nothing tricky in this. Actual interest of 8.6, actual interest of 7.8. Okay, now let's understand the question. I wanted to borrow when? For a period of 3 months in the coming 6 months time from now. Tell me which FRA will be useful here. FRA 6 by 9. FRA 6 by 9. Question has not given any FRA rate, but some problem will give something like this where you need to understand which FRA is to be used. 3 by 6 or 3 by 9. Student is not even aware whether to use 3 by 6 or 3 by 9. So that confusion can come. That is where that understanding is needed. FRA, what FRA we are using. So in this case, we are using which FRA? 6 by 9. They have not given anything. What is the FRA rate they have mentioned? 8.3. Listen, very simple. If actual interest is 8.6, pay 8.6 and get a compensation of 0.3. Get a compensation of 0.3. And if actual is 7.8, pay 7.8 and pay a compensation of 0.5. Pay a compensation of 0.5. Effectively, you will pay 8.3. Effectively, you will pay 8.3. One adjustment alone is needed, which is called net settlement. Some discounting needs to be done. Point number one, interest paid to bank. Interest paid to bank. What is the loan amount? 50 crore into 8.6%. How many months is the interest? 3 by 12, 7.8. When are you taking the loan? Month 6. We are taking the loan on month 6. This interest will ideally be paid in month 9. This interest will be paid in month 9. Loan got over, you paid the interest. FRA settlement. Now, what happens is FRA will be settled in month 6 itself. FRA will be settled in, that is when you're taking the loan. When you're taking the loan, you will get your compensation. You will get your compensation. You are paying extra 0.3% in month 9. Compensation will come now itself. Some discounting needs to be done. Some discounting needs to be done. Listen, FRA settlement is 50 crore, 0.3%. I will receive 0.3. Why will I receive 0.3? What is the FRA rate? 8.3. What rate did I pay? 8.6. So I need a compensation of 0.3. I need a compensation of 0.3. Wait. This amount will be discounted. This amount will be discounted by the actual interest rate. What is the actual interest rate? 8.6. What is the actual interest for 3 months? 1 plus 2.15%. 1 plus 2.15%. I'll repeat again. What we are doing is we pay the interest to the bank on month 9. FRA settlement happens in month 6. If it happens in month 9, I will get exactly 0.3% into 3 by 12. I'll get exactly 0.3% into 3 by 12. But bank is saying this interest is paid to ICICI. SBI is now telling I have to pay you now. I'll pay, no problem. But let me deduct the adjustment factor, which is the discount rate, So he will discount this by the actual rate. He'll discount this by the actual rate. From month 9, you are coming to month 6. From month 9, you are coming to month 6.
The payment is made on month 6. Take that to month 9.
I'm not doing any comparisons. I'm not doing comparison here. See, listen. The settlement will happen in month 6. I'm not doing any comparison of month 6, month 9. You came to a point which is not needed as of now. So I am basically saying, if the bank pays in month 9, he will pay me 0.3% of 50 crore. He is saying I'm ready to pay that, but you are not ready to wait till month 9. You are not ready to wait till month 9. You want immediate settlement. That's how FRA is settled. So he's saying, let's do that. We have no problem with that, but let me discount that amount and give it to you. Any doubts on this? Any doubts on this? Write this amount. I'll show you what happens if you don't do discounting in a minute. If actual interest is 7.8, should I give compensation or receive compensation? How much percentage I have to give? 0.5. Discounted by what rate? 7.8 for 3 months is how much? Any doubts on this? So this is my settlement of FRA. This is my settlement of FRA, which you need to discount by the actual rate. Total interest paid. You complete whatever I'm telling you, then I'll explain one concept. Loan taken and effective interest rate. Loan taken is 50 crore. Effective interest is interest paid by 50 crore into 12 by 3. Both should be same. Some difference will be there. I'll explain. This divide by 50 crore into 12 by 3. 8.31, 8.29. Okay, let me explain the concept again. I will take a loan at 8.6 or 7.8. I will have to pay compensation or receive compensation for the difference. Assuming you don't do discounting. You don't do discounting. You have to do discounting, but assuming you don't do discounting, both will give you exact 8.3. Both will give you exact 8.3. Both will give you exact 8.3. What ICI has done is they do discounting, which is correct. They do discounting, which is correct. But for calculating effective interest, in one exam they did like 8.31. In another exam they did it 8.3. In settlement alone they did without undiscounted. Without the, in one exam they gave this answer. In another exam they gave. Discounting is right, okay? Discounting has to be done. But effective rate of interest, November 2018 RTP, they presented this. November 2019 exam, they presented this answer. I will prefer you to follow this, because this has come more recent. This has come more recent, but again I'm repeating, everything is perfect. I say solution has no problem. Only problem is I cannot add month 9 and month 6. I cannot add month 9 and month 6, which is where you had that point. So ideally without discounting, I should calculate my effective rate. But settlement will happen only with discounting. Settlement will happen only with discounting. No settlement without discounting. Let's be very, very clear. Settlement will happen only with discounting, and you have to do discounting at the actual rate. If you don't do discounting, you will lose marks. You will lose marks. Any doubts on this?
Basically, we receive the money
On month 6.
We put it in FD.
Correct. Yeah, that's the logic which they presented in one RTP, undiscounted, but sometime they did not present. Clear? Any doubts on this? Let's come to the next one. Following market data is available. Deposit rate USD JPY 3 month, 6 month, 4.5, 0.25, 5.25. Listen, this is 4.5 per annum. This is also per annum. This is per annum. This is per annum, because interest rates are normally for a year. Interest rates are normally for a year. What should be the 3-month FRA rate at 3 month forward? What should be the 3-month FRA rate at 3 month forward? That is after 3 months. What is the 3-month FRA rate? So they're asking what? FRA 3 by 6. FRA 3 by 6. Very simple formula. I did this when I was doing your security valuation. FRA 3 by 6, right? Future value factor for 6 month divided by future value factor for 3 month minus 1. Future value factor for 6 month divided by future value factor for 3 month minus 1. 6 month divided by 3 month minus 1. What is the 6 month proportionate interest rate for US dollar? Yen is already given. US dollar, tell me. 1 plus 2.5%. 3 month proportionate. How is it 2.25? 1.125 minus 1. Which part you did not get? 5 divided 5 is per annum. 6 month is 2.5% per 6 month. 4.5% is per annum, or 1.125% per 3 month. 1.125% per 3 month. You'll have to take the 6 month interest and 3 month interest. What's the answer you got? Sorry? 1.36 per 3 months. 1.36 per 3 month. Why 3 month? Because this is the gap between 3 and 6. This is the gap between 3 and 6. The gap between 3 and 6 is 1.36 R. Tell me the annual rate. I'll explain this again with one more example so that you get better clarity. 6-month LIBOR is 5%, 12-month LIBOR is 6.5. 6-month LIBOR is 5%, 12-month LIBOR is 6.5. There's an arbitrage part which I'm not getting into now because it will confuse a lot of other things. If you get clarity on arbitrage, great. Otherwise, in the concept book, see it later. Okay. I don't want to get into arbitrage now. Unnecessarily, it will confuse, complicate things. 6 month is 5. Bank has given 6/12 FRA. Bank has given 6/12 FRA. I will also now calculate a 6/12 FRA. I'll calculate a 6/12 FRA. This is to check arbitrage. We are not going to do arbitrage part. We are not going to do arbitrage, but to check arbitrage, I will calculate a 6/12 FRA. Now, right, FRA 6/12 is equal to, what's the formula? Future value factor for 12 months divided by for 6 month minus 1. What is the 12-month rate given? 1 plus 6.5% directly. 6-month rate 5% is for a year. 5% is for a year. 2 point minus 1. 2.5% minus 1. 3.90% per 6 month. Per 6 month or give me the other answer. I'm not getting into the arbitrage part because the entire flow will get affected. I don't want to get into arbitrage now because you will end up thinking too many numbers. You will unnecessarily affect the flow of the discussion. I'll get into the last part of the chapter. Which is on an area called interest rate swaps. So we have done with interest rate options. Listen, from an exam point of view, so many concepts were discussed. What is very critical is, one is getting the net settlement of a cap option, floor option. The initial 2 questions we did, and cap, floor put together a collar option. That is one set of question which is frequently tested. Futures, I've not seen much questions getting tested in exam. Futures, very rarely they've tested. FRA net settlement is again frequently tested. Calculating the net settlement of FRA is again frequently tested exam question, which is also easy to do. FRA net settlement is easy, cap settlement is easy, floor settlement is easy, and collar settlement is also easy. These part of the questions are on the easier side. The complex part, according to me, is just the futures part. The futures working because you are not able to relate much. Now, coming to interest rate swap, we have multiple questions, but broadly 3 category of questions will keep coming in exam. One is structuring of a swap, where we will do 2 questions. Second, calculating a net settlement. Again, there's something called as a net settlement, which is 1 question. And reverse working a fixed rate or a floating rate. These are the 3 type of question which comes very frequently in interest rate swap. Let's understand first what is interest rate swap. Okay, now listen, there are 2 types of loans in the practical world. One is a fixed loan, second is a floating loan. What is a fixed loan? The interest rate will remain same for the entire duration of the loan. I will like this if I believe interest rates will go up. I will like this if I believe interest rates will go up. I will also like this if I don't want to take any risk. If I don't want to take any risk. Practically, fixed loans are almost negligible. Very rarely you will get a fixed loan. Longer period, they give only floating loan. Floating loan is preferable where you believe interest rates will decrease. You believe interest rates will decrease, then you'll do. ABC has taken a floating rate. I have taken a floating rate. I have used an interest rate swap. I have used an interest rate swap and converted the same into what? Fixed rate. See, a swap can convert a fixed loan into floating, floating into fixed. How does it do? We'll understand that later, but it can do that conversion. So I took a floating loan, but I've now converted into what? Fixed loan, which means I've indirectly taken a fixed loan. I've indirectly taken a fixed loan. If I have taken a fixed loan, I will prefer if interest rates will increase. Interest rates will increase. See, I have not taken a floating loan now. I've converted it into what? Converted it into a fixed loan. So effectively, you have taken a fixed loan. Effectively, you have taken a fixed loan. Will convert a floating loan into a fixed loan if they expect interest rates to increase. Conversion will ensure that they are not affected by increase in interest rate. Now, how is this conversion done? It is done through IRS. It is done through IRS. How does it happen? I'll directly now get into an example so that you understand IRS properly. Let's get into an example. Let's come to 17. M Limited is an Indian company. They are in the process of raising a US dollar loan and are negotiating the rates with a foreign bank. Company has been offered a fixed rate of 8% with a proviso that if you opt for a floating rate, it will be linked to a benchmark of 60 basis point over 10-year US Treasury bill rate. Similarly, Madagascar Limited, they have given certain number. On inquiry, you found a swap arrangement which is possible. Swap differential is shared equally 3:1 and swap banker charges. So all the three situation if I do, you will understand how an intermediary works, how normal swap is done. Just go through the question, then we'll try to take you through the solving part of it. It's going to be very simple. The solving part is extremely easy, and unfortunately this is an area which most of the students find it difficult. So see, I cannot say everything is so easy in interest rate option, interest rate futures and all, because you're not able to relate to the numbers, you find it difficult. But this is very simple. Whatever is tested in exam is very simple. Cap settlement very simple, floor settlement very simple, collar settlement very simple, FRA settlement is very simple, and this structuring is also very simple. ICI material has a lot of things and all. I'll not get into that. I'll explain in an easy manner. Now, whatever data is there, I want to put it in one table form. Okay, you will tell me the numbers of the table. We'll do it together. Now, write particulars and two companies. Particulars. What are the two companies? M Limited, S Limited. Please write along with me. Please write along with me. You will find this to be very easy if you write along with me. M Limited and S Limited. Read the table and tell me what is the fixed rate of M Limited.
8%.
Again, read the table and tell me what is the floating rate of M Limited. T plus 0.6%. T plus 0.6%. Give me similar number for S Limited. T plus. Very simple. This is very simple. You have written this. Okay. Now, the companies, let's assume it is a group company. M and S are known to each other. M and S are known to each other. See, an IRS will come into picture when one party wants fixed, another party wants floating. Both want fixed, both want floating. Go ahead and borrow in the market. IRS cannot do anything. IRS cannot do anything. I can do one, the red combination, or I can go for the other combination. There are two combinations which are possible. One is a red combination, other one is a blue combination. What is the total interest of the red combination? T plus 9.8. Now write combination 1. Combination 1, 8 plus T plus 1.2, T plus 9.2. T plus 9.2. Combination 2, add and tell me. 9.2 plus T plus 0.6. T plus best combination is this. That is, I want them to borrow. At this rate. This is the best combination. Question will say, no, we don't want to do this. We want to do opposite of this. If question says M Limited wants fixed, S Limited wants floating, swap is not possible. Because you want the best one. Please go ahead and take the best one. What is the best one? The yellow shaded one. The yellow shaded one is the best one. Question will say they don't want this. They want the other one. What does M Limited want to borrow? Somewhere they would have mentioned in the question. Tell me. M Limited wants to borrow at what? M Limited wants a flexible mechanism. M Limited wants a flexible mechanism. Anything mentioned about S limited? No. Assumption is S would have wanted the other one. S would have.
That is just because it's lower interest.
Lower interest. T plus 9.2 is better than T plus 9.8. T plus 9.2 is obviously better than T plus 9.8. Why should I pay T plus 9.8? But now he is saying, no, I don't agree to you. We want this. I am telling yellow is the best one, but he is saying I want the green portion. I want the green mix. If this happens, IRS exists. If this happens, IRS exists. He tells no, I want only the green one, and nothing can be done. Sorry, he wants only the yellow one. If he wants the yellow one, it ends there. Yellow one is the ideal. Yellow one is the ideal. In this case, yellow is ideal and green is what is wanted. Green is what is wanted. Ideal is T plus 9.2. But he is not ready to listen to us. He is not ready to listen. He is saying, I am telling you what you need to do. I am telling you what you need to do. If this happens, IRS exists. If this happens, IRS exists. Now come down. Benefit of IRS. Benefit of IRS. Benefit of IRS. Gap between the two rates. T plus 9.2 compare T plus 9.8. What is the difference? 0.6%. In first situation, 0.6 goes to in what ratio? M will take some, S will take. Now, before I do the structuring part, I'll give you the final effective rate. I'll give you the final effective rate. Assume you are not able to do the structuring properly in exam. Structuring is easy only, but you get stuck with the structuring. I can tell you what is the final borrowing rate. Final borrowing rate is what you wanted. What is wanted is green. What is wanted is green. So now write effective borrowing rate of M limited is equal to T plus 0.6. In this, I will save 0.3%. What is 0.3% saving? Saving, sharing of swap gain. Swap gain 0.3% you will save. So you will effectively pay how much? And effective borrowing rate of S limited is equal to 9.2 minus 0.3%. 8.9. 9.2 minus 0.3, 8.9. Again, I'll explain. Yellow is the ideal. He is not ready to listen. Okay, let him not ready to listen. He says, I want the green one. I want the green one. If he goes ahead and borrows, he will get a T plus 0.6. IRS will make it T plus 0.3. IRS will make it T plus 0.3. How does it make? We'll see in some time. If S limited borrows at 9.2, IRS will make it 8.9. IRS will make it 8.9. How does it make? We'll see now. Any doubts till this? Higher minus lower. Higher rate minus the lower rate. In short, required minus the ideal, but higher rate minus the lower rate. Clear? Any doubts till this? I had a gain of how much? 0.6. I'm sharing it as 0.3 and 0.3. In the rework, what is the share? 3:1. Directly you can calculate. You need not write this now. Minus 0.45 minus 0.15. Minus 0.45 minus 0.15. In the third situation, what is happening? How much is the intermediary going to charge? 0.1. So of the 0.6, 0.1 is gone. Leftover is how much? 0.5. Share it as 0.25, 0.25. In your effective borrowing rate, 0.25, 0.25 will go. This can also be understood. Intermediary will charge 0.1 from me, 0.1 from the other guy. So he charges 0.2. He charges 0.2. Leftover is 0.4. Again, share it as 0.2, 0.2. You can understand it in different ways. So what happens is, he is saying he wants to borrow T plus 0.6. I am telling don't do this. I am telling him don't do this. I will reduce the rate for you. I will reduce the rate for you. You believe me, I'll do something for you. This is what IRS is going to do. Now, if you are clear till this, let me know. Any doubts till this? Till this, you will get 75-80% of the exam marks. 75 to 80% of the exam marks will be at this stage itself. That is if you are able to find the effective borrowing rate. But structuring is also very critical. How to do structuring is what I'll explain now. Any doubts on this? Now write structuring, particulars and two companies. Structuring. Structuring. Borrow from bank as per ideal combination. Borrow from bank as per ideal combination. In your ideal combination, what should M take? What should S take? Tell me. Ideal.
M should take 8%.
M should take. Okay. S. T plus 1.2. Borrow from bank as per ideal combination. Clear? Point number 2. M limited. Sorry. S limited. Listen for some time. To M limited. S will give something to M. S will give something to M. M will also give something to S. M will also give something to S. That is what swap. Swap means I have to give something. He has to give me something back. And point number 4 is effective borrowing rate. Effective borrowing rate already you have calculated. Tell me the effective borrowing rate.
Plus 0.3%.
T plus and this side. Now very simple. Whatever M paid, I'm doing from M point of view. Okay, you can do from S point of view. You can do from M point of view. Whatever M paid, I want to receive from the other party minus 8. I want to receive from the other party. Listen for a minute. Listen for a minute. Whatever, just give me this one. Thanks. Whatever I paid to the bank, I want to receive from the other party. I want to receive from the other party. So negative 8. I receive from the other party. Other party is paying this. Other party is paying them. For them it is outflow. Can you tell me 1 plus 2 plus 3 is equal to 4? What should be the balancing figure there? T plus 0.3. T plus 0.3. I'll repeat again. First company is telling the second company, you pay me whatever I have paid bank. You pay me whatever I have paid bank. So he has paid me this. He has paid me this. What I do is I pay him T plus 0.3. I pay him. See, receipt is written as in bracket. Receipt is written in bracket. Total of 8 minus 8. T plus 0.3 is T plus 0.3. Total of T plus 1.2 plus 8 minus T minus 0.3 will be 8.9. Will be 8.9. T plus 1.2 plus 8 minus T minus 0.3 minus T minus 0.3 put together is 8.9. Put together is 8.9. So what we have done smartly here is I borrowed as per the ideal combination, did exchange of this, put together our interest is now T plus 9.2. Put together our interest is T plus 9.2. Whereas if you had gone without swap, you would have paid T plus 9.8. You would have paid T plus 9.8. I'll explain again one more time. Listen. I'll come to it in a minute. Till this, I don't see any confusion. Okay. Till this, there cannot be any confusion. One party has to pay something to the other party has to pay something to the other party. Whatever you are receiving, I'm going to write in bracket. What I do is whatever I wrote here, I want to write that as minus. I want to write that as minus. If you write here it is minus, for the other party it is plus because he has to pay. He has to pay. Balancing figure is exactly this. Balancing figure is exactly this, which is T plus 0.3. This side you write in bracket. T plus 0.3. Now if you put a total 8 minus 8 plus T plus 0.3 is T plus 0.3. T plus 1.2 plus 8 minus T minus 0.3 is 8.9. You write this, let me know if there are doubts. Second is S is paying me. I am receiving. My receipt is inflow. Receipt I have written in bracket. Okay guys, everything is outflow. Whatever I am receiving I have written in bracket. What is written in bracket is a receipt for me. What is written in bracket is what I receive, so that I cancel 8 and 8. What I pay is written as positive. What I receive is written as negative in this table.
You want only pay interest at floating rate. I have entered a fixed loan for which he is compensating. Of the day I'm giving.
Net you're paying the floating rate. Yeah, tell me. Answer will not change. Structuring will change slightly. But the final answer will be T plus 0.3, 8.9. The structuring can change. I'll show you the structuring because you have asked. I'll show you that structuring. First, write this. We'll do one with swap intermediary, so you get a little bit clarity with the intermediary part, and one more question so that you get a different flavor of a problem. Any doubts till this first? Okay, assume he has asked this S pays first to M pay M to S and S to M. Nothing much is going to change. Just that if you are doing from S point of view, I paid this T plus 1.2. You give me that. You give me T plus 1.2 so that I cancel that. I cancel that. So I'll write minus T plus 1.2%. I'll cancel this. I will cancel this. Balancing figure is 8.9. Balancing figure is 8.9. See, very simple. Row 2 is minus of row 1. Row 2 is minus of row 1 and row 3 is equal to row 4. Row 3 is equal to row 4 for one party. For one party. For the other party, if you write minus here, other side you have to write plus. So what happened other side? T plus 1.2% minus 8.9%. Minus 8.9. 8 plus T plus 1.2 minus 8.9 is equal to T plus 0.3 is equal to T plus 0.3. Effectively, you will get that rate. Effectively, you will get that rate. Any doubts on this? The structuring can change, whether you can do from M starting or S starting, that's your wish.
Both are acceptable as per ICA, no, sir?
Yeah, both are acceptable as per ICA. Similar amount, yes. Same amount, same time period, everything has to be same. Now guys, listen. Is this two different answer? No. Here 8 is exchanged for T plus 0.3. Indirectly T is exchanged for 7.7. 8 vis-a-vis T plus 0.3. So T is technically exchanged for 7.7 and here also T is exchanged for 7.7. T is exchanged for 7.7. It's not a different answer and all. Basically T is exchanged for 7.7%. T is exchanged for 7.7%. Any doubts on this? Now I bring an intermediary. Now write particulars M limited, S limited. Particulars M limited, S limited. Borrow from bank as per ideal combination remains. Borrow from bank as per ideal combination remains. What was the total gain? 0.6. In that intermediary takes away 0.1, leftover is 0.5. Share does what? 0.25 for M limited and 0.25 for S limited. Right this. 0.25 for M, 0.25 for S. Intermediary is the easier of the lot. If intermediary is coming, it's very easy to do the structuring. Effective borrowing rate of M limited. M wanted to borrow at what rate?
T plus 0.3.
T plus 0.6. In that subtract 0.25. Effective borrowing rate of S limited. S wanted to borrow at what rate? Minus 0.35. See, if you are able to do structuring, great. If you're not able to do structuring, then you stop with effective borrowing rate. Stop with effective borrowing rate. Structuring is not difficult. You practice 2-3 times, things will automatically fall in place. How much is this? Now, listen for just 2 minutes. Very simple. What happened? Any doubts? Listen. Receive from swap intermediary, pay to swap intermediary, effective borrowing rate. This is very simple. My effective borrowing rate I calculated T plus 0.35, 8.95. What will I receive from swap intermediary? Whatever I paid. Whatever I paid, I will receive it. Whatever I paid, I will receive from the no M to S, no S to M. No M to S, no S to M. So I receive 8%. Now right, I receive T plus 1.2%. I receive 8%. I receive T plus 1.2%. Whatever you paid to the bank, you receive from the intermediary. You receive from the intermediary. Very simple. Whatever you paid, receive from the intermediary. Both got cancelled. Both got cancelled. What do you pay? You pay your effective rate. 3 and 4 is same. 3 and 4 is same. What you pay is the effective borrowing rate. What is 0.25? Okay, sorry, 0.25. See, I'll repeat again. When you have an intermediary, it becomes more simpler. What is the calculation? First, you pay to the bank as per the ideal combination and you will receive that amount. You will receive that amount from the intermediary. What do you pay to the intermediary? You pay your effective rate. You pay your effective rate. Now listen. This is from an intermediary point of view. For intermediary, this is payment. This is receipt. This is payment. This is for the intermediary. Tell me the total of the payment and total of the receipt of the intermediary. Of the intermediary, what is the payment he is making and what is he receiving? T plus 9.2. This is 8 is also T plus. See, this is payment. This is also payment. Both are payment of the intermediary. What is he receiving? T plus 9.3. Gap is his income of 0.1. Gap is his income of 0.1. See, when it's intermediary, it's very simple. Again, I'll repeat. In intermediary, you just need to do very simple calculation. First, put your borrow from bank as per ideal combination. Receive exactly the same. Receive exactly the same. 1 and 2 got cancelled. 1 and 2 got cancelled. What will you pay? Your effective borrowing rate. 3 and 4 is same. 3 and 4 is same. Pay to the swap intermediary. Receive from the swap intermediary and effective borrowing rate. To cut it short, effective borrowing rate is equal to originally planned borrowing rate minus the share of swap gain. Minus the share of swap gain. The second type of a question which comes frequently is calculating something called as a net settlement. Go through this. Very simple calculation. Go through this. Suppose a dealer quotes all-in cost for a generic swap at 8% against 6-month LIBOR flat. That is, one party will pay 8%, other party will pay 6-month LIBOR. Semi-annual fixed payment is very simple. No days calculation, nothing. Now write 5 lakh into 8% into 6 by 12. That's all. No extra adjustment on this. No days, nothing will be brought in. Semi-annual fixed payment is very simple. 5 lakh into 8% into 6 by 12. How much? This will remain same for the first half year, second half year, third half, fourth half. Any time you do, it will be 20,000. Floating has a problem. Floating has a problem. Floating will depend on actual LIBOR. What is actual LIBOR? 6%. Also, how many days are there? So you have to do 181. Divide by not 365 because below they have said 360. Below they have said 360. So you have to do 181 by 360. 181 by 360 because they have used the word 30 by 360. If they don't use the word, do 365. Do 365. In floating, number of days is to be brought into picture. Number of days is to be brought into picture. What is the denominator? I'll come to it. Do the calculation first. Now there will be a net settlement. There will be a net settlement. What is net settlement? 20,000 minus 15,083. Who will receive? Who will pay? A person who was to pay the fixed rate. A person who was to pay. In this question, a dealer quotes all-in cost for a generic swap at 8% against 6-month LIBOR flat. If the notional principal is 5 lakh, semi-annual fixed payment, first floating payment. Question nowhere mentioned who's paying, who's receiving. That's not mentioned. So if you are paying fixed, you have to pay 20,000. And if you are paying floating, you have to pay 15,083. Who will settle whom in the end? Fixed has to settle the floating guy. It can be the other way around. If the actual interest was 10%, if the actual interest was 10%, Floating will settle the fixed guy. Floating will settle the, so saying if the settlement is on net basis, if the settlement is on net basis, what should the fixed rate payer pay to the floating rate payer? What is the fixed payment? 20,000. What is the floating payment? 15,017. So you have to give me 20,000. I have to give you 15,083. Net net you pay me the difference. Net net you pay me the difference. If I had to pay you more, I would have paid the difference to you. I would have paid the difference to you. Any doubts on this? Clear? Can we proceed? Tell me what is the issue. You have to tell me what is the issue.
Why should he? That guy should receive. Because he is only paying more.
No, I never said fixed guy. What did I say now? I only said fixed guy has to pay
Why should
20.
he compensate? Because he is already paying 20.
He is not paying 20. He will pay the net amount 20,000 minus 15,083. Nobody is going to pay 20,000. Nobody is going to pay 15,083. I have to pay you 20. You have to give me 15,083. What will we do? Instead of I paying you 20,000, you paying me 15,083. I say don't pay me 15,083. I'll give you 4,900. That is what net settlement is. What is net settlement is? I will not pay you 20,000. Let me be very clear. You will not pay me 15,083. We will settle net. It can be the opposite also. What is opposite? If it's 10%, tell me 10% means how much?
25,139.
25,000. Now, fixed guy will not pay you 20,000. You also need not pay me 25,000, but you have to pay me now 5139. You have to pay me 5139. Clear net amount. That is why it is net settled. It is net settled. Net payment by fixed rate payer to the floating rate payer. Net payment by the fixed rate payer to the floating rate payer. Why fixed rate payer is paying? Because he has to pay higher amount. He has to pay higher amount. Is he going to pay 20,000? No. Are you going to pay 15,000? No. Net amount 4917. Any doubts on this? This is a frequently tested exam question. Okay. Next. Another frequently tested is this. Go through this. This is another category of frequently tested exam question. Derivative bank entered into a swap arrangement on a principal of 10 crore, agreed to receive floating rate. So I will receive floating rate. I will pay fixed rate. Swap was entered on August 2, commences on August 3, run for a period of 7 days, Tuesday to Monday. In that, they have given 6 rates. Why 6 rates? Because in between Sunday is a holiday. Sunday is a holiday. What is the swap arrangement? The swap arrangement is called overnight index swap. This is basically a swap. This is basically a swap arrangement. You can call it as plain vanilla overnight index swap. Plain vanilla overnight index swap. Now let's understand how will working happen. See, fixed rate guy will pay what is 10 crore into one rate into 7 by 365. Floating guy, what happens is whenever interest changes, there will be something called interest on interest. There will be something called interest on interest, because first day you will calculate interest at what rate? 7.75. This interest will be added to your principal, and next day you will not calculate on 10 crore. You will calculate on a slightly higher amount. You will calculate on a slightly higher amount. At what rate? 8.15. Next day again amount will increase. Next day amount will increase. Now write working note 1, computation of interest under floating leg. Computation of interest under floating leg. Interest under floating leg. Particulars. Interest rate. Opening balance. Interest. Closing balance. Copy whatever rates they have given. Starting from August 3, or I'll call it as Tuesday because that is what I need. Wednesday, Thursday, Friday, Saturday, and then you move to Monday. 7.75, 8.15, 8.12, 7.95, 7.98, 8.15. Original amount is 10 crore. On 10 crore, I'll first pay interest for 1 day at what rate? 7.75%. So 10 crore into 7.75 percentage into 1 day. 1 day calculation. 21,233. 21,233. Now closing balance is what? 10 crore 21,233. This is one extra benefit of a floating rate. This is one extra benefit of a floating rate. Next day interest is not on 10 crore. Next day interest is not on 10 crore. It will be on what now? 10 crore 21,233. Calculated 8.15% again for 1 day. Will it make a big difference? Not a material difference, but yes, working is this way. 8.15% for 1 day. Come till Saturday and then wait. Wait at Saturday. Saturday, what happens is because Sunday is a holiday, I'll directly calculate 2 days interest. I'll directly calculate 2 days interest on Saturday. I'll directly calculate 2 days interest. So into 2 by 365. And again then 1 day interest. Saturday directly 2 days interest. Will be missed. Compounding will come only when interest changes. So if your interest is not changing, that is why float fixed directly the rate into 7 days. No compounding. Compounding can come when interest changes. Assume interest do not even change. Directly into 2, into 3, into 4, into 5. I can give benefit only when interest is changing. So Saturday and Sunday technically interest on interest is not coming. Technically that interest on Saturday interest, you are not earning interest on Sunday. Any doubts on 153, 740? Can we proceed? Any doubts on this? Okay, so listen. Interest under floating leg is 153,740. Interest under fixed leg I have to calculate. What did derivative bank receive or pay? Derivative bank received how much? Now please understand my question properly and then answer, okay? Derivative bank has received 317. What derivative bank is saying is, I have entered into a swap arrangement where I will receive the floating from you and pay what? Fixed. Agreed to receive the floating and pay the fixed. Receive the floating and pay the fixed. Net I have received 317. Net I have received 317. Will the fixed be more than floating or lesser? It will be lesser. It will be lesser. No, why more? Someone in the live online.
I mean, floating will be more, fixed will be lesser.
Yeah, okay. 153740 minus 317. 153740 minus, this is what happened in the previous question, 20,000, 15,000 net settlement. How much is this amount? 153. This 153423 is 10 crore into a rate of interest into 7 days. 10 crore. That rate of interest is called fixed rate. That rate of interest is called fixed rate. 10 crore into rate of interest into 7 by 365 is equal to 153423. Directly 7 days calculation. Get the fixed rate. 10 crore into the rate of interest. You will get it in decimals, okay? Into 7 by 365. Sorry, 88. 8%. 0.79999. So it's basically 8%. Sorry, it should 0.0799. It is basically 8%. It's basically 8%. See, under fixed leg, what happens is no compounding. No compounding, directly 7 by 365. Directly 7 by 3. It is the reverse calculation here. The reverse calculation is presented here. You need not worry about it. Basic thing is 8% is the rate. 8% is the rate. So these are the three normal type of question which keeps coming in interest rate swap. One is the structuring part. Second is net settlement calculation. Third is using the net settlement. Using the net settlement, we will go ahead. We will go ahead and calculate the rate of interest. We'll go ahead and calculate the rate of interest. So interest rate swap. I'll quickly maybe revise from the beginning and then close it now. I'll quickly revise it from the beginning. Exactly 10 minutes for us to revise. Listen. There are 4 tools for doing interest rate risk management: options, futures, FRA and swap. Option, futures, FRA and swap. What happens? The option is you have a cap option, floor option, collar option. Cap is useful if interest rate goes up, floor is useful if interest rate goes down, and collar is in between. Collar is in between. You want to pay in between. Why do you need collar? To reduce the premium. To reduce the premium. Forward rate, interest rate futures is basically what happens is, okay, this is the settlement part. Terms associated with the interest rate option. You have a term called notional amount. You have a term called reset period. Notional amount is the amount for which the contract is entered. Reset period is the date on which the interest is reset. It can be for the past period. It can be for the future period. How is the premium calculated? Notional amount into the lump sum premium percentage. This premium divided by present value annuity factor, fixed rate of interest, and the amortization and the number of reset period. Then comes the interest rate future. First, interest rate future, how they mention. If they mention 95, interest rate is 100 minus 95. If they mention 92, 100 minus 92. Now, this interest rate future has 3 challenges. One is my amount may not match. So, how do I make it match? I do 100 crore into 3 months is equal to question mark into 2 months. I'll get that amount. If I get it in decimal, I have a problem which there is no cure. And third is a basis risk. Third is a basis risk. How is the settlement happen? First, you will borrow at the actual rate. You will borrow at the actual rate or invest at the actual rate. Borrow or invest at the actual rate. How do you get net settlement? Date, position, action, reference date and rate. First, you will get the profit or loss in percentage, and to convert into rupees, profit or loss in percentage into whatever notional amount, into the number of contract, into a settlement period, which can be 3 by 12, loan can be 4 by 12. Loan can be 4 by 12. Future settlement period is distinct from your contract expiration period. Then comes a cheapest to deliver bond. What is cheapest to deliver bond is I don't want to deliver, but you are forcing me to deliver. I'll deliver by buying it. I'll deliver by buying it, which is my quoted price. That's my outflow. When I give, you will pay me future settlement into a conversion factor. The gap between that is my profit. I'll select a bond which gives me maximum profit. Select a bond which gives me maximum profit. FRA is basically like a forward contract where we are trying to freeze the future interest rate. How you do? You enter into an FRA agreement today to freeze your future interest rate. It could be for borrowing purpose. It could be for investment purpose. If you have entered for borrowing purpose and actual interest is more, pay more and get compensation. Actual interest is less, pay less and pay compensation. If you have entered for investment purpose, if your interest rate is higher, receive higher and pay the compensation. Receive higher and pay the compensation. And if it is lower, Receive lower, receive compensation. Receive lower and receive compensation. FRA has to be net settled. Undiscounted amount, contracted rate minus the actual rate, notional amount into month by 12. Set discounted amount, undiscounted settlement divided by 1 plus the actual rate. 1 plus the actual rate. Computation of FRA rate. You can calculate FRA 3 by 6 as future value factor for 6 months divided by future value factor for 3 months. FRA 6 by 12 future value factor for 12 months divided by future value factor for 6 months. Using the FRA, you can do arbitrage where you compare two things, fair FRA rate and actual FRA rate, and an arbitrage strategy will be decided. You can just go through that part of it. The next segment is what action do I take? In an interest rate future, sell is borrow, buy is investment. In an FRA, buy is borrow, sell is investment. There are two type of loan. There's a fixed loan and a floating loan. Fixed loan is preferred when interest rates are likely to increase or I don't want to take risk. Floating is preferred when interest rates are likely to go down. How do I structure a swap? First, identify what is the ideal combination. Identify what is the required combination. Companies opting for ideal combination, swap is not possible. No extra calculation. They are opting for different, swap is possible. What is the gain? Gain is the difference in total interest of the combination. Pay to banker as per the ideal rate. Receive from the other party what you paid. Pay to the other party your effective rate. For other party, all are balancing figure. If you bring in swap intermediary, very simple. Pay to the bank as per the ideal rate. Receive from him. Pay to him our effective rate. 1 and 2 is same. 3 and 4 is same. Question will sometimes use the word hardening and softening. What is hardening? Is interest rates are likely to go up. What is the use of this? If interest rates are likely to go up, I want what type of loan? Fixed loan. And softening means interest rates are likely to go down. I want a floating loan. What is expectation theory? Is calculating FRA. That FRA 4 by 5, 3 by 4. That is technically expectation theory holding good. So if you do FRA 3 by 4, future value factor for 4 years divided by future value factor for 3 years is technically calling expectation theory holding good. Locked in spread, there's one example. Go through the example. What is locked in spread is I invest at one rate, I do a swap and I do another swap. In this process, I'll be able to freeze my profit. For example, I invested at 8.5. I borrowed at LIBOR plus 0.5. If I leave this, I will have profit sometime, I can have loss sometime. How can I have a loss? If LIBOR plus 0.5 goes above 8.5. LIBOR plus 0.5 goes above 8.5. Using the swap, I can cancel this LIBOR. And get something called as a fixed rate. Fixed payment would be same for every reset period. Floating is notional principal into the floating rate into 360 or 365 and effective rate will be given. What is the net settlement? Find out the difference. And using this difference, okay, that question is not that. Using the difference, you can find out the reverse work, something called as the fixed rate. Clear? Any doubts on this? Done? You can just write just two things, just write. Cap settlement, floor settlement, collar settlement, premium computation, cap, floor, collar settlement, premium computation, FRA, net settlement, IRS structuring, these are the usual type of question. Okay, 8 category I have given. Cap settlement calculation, floor settlement calculation, collar settlement calculation, premium computation and amortization of premium, FRA net settlement, IRS structuring, IRS net settlement. What is net settlement? Fixed versus floating, and reverse working. Fixed versus floating. IRS net settlement, fixed versus floating.